Hey, what's up, my friend? So in today's training, I want to share with you 5 things to look out for before you place a trade. Because I get it, right? When you're trading the markets, there seems to be like so many things to look out for. You know, support, resistance, trend line, multiple time frame analysis, indicators, candlestick patterns, chart patterns. Help, Rayner! So I get it, right? You are overwhelmed, you're confused, and you don't know what to do, right? So in today's video, I'm just going to break it down to you step by step, right? And to point you in the right direction, right? To focus on just these 5 things. If you can focus on these 5 things, you can pretty much ignore everything else. Sounds good? Then let's get started. The first thing that I want you to pay attention to is market structure. So the point of market structure is all about asking yourself, where's the path of least resistance? So if you see a chart, right, the market is in an uptrend, then what do you want to do? Well, you want to buy, of course. You want to be buying in an uptrend. And likewise, if a market is in a downtrend, then what should you do? You should buy. Now I'm just smoking you, right? You should be selling, right? You should be selling in a downtrend. And if the market is in a range, you can trade both sides, either, buying or selling. So that is pretty much, right, what you're trying to do with the first step, right? Identify the market structure. Identify the path of least resistance. And the way to do it is to classify the type of trend the market is in. Is it in an uptrend, a downtrend, or a range? Don't complicate things further. And let me give you a few examples. So you see this one over here, right? This one clearly, right, the 5-year Treasury note futures. What is the trend of this market? I'm sure you can agree that this is a uptrend, right? The price is making a series of higher highs and higher lows over time. Series of higher highs and higher lows. Simple stuff, right? So in this type of market condition, in this time frame, right, you want to be looking for buying opportunities, right? Likewise, if you look at this one over here, the oil market. What is the market structure at this point in time? Again, simple stuff. Don't complicate things. Series of lower highs and lower lows. So what should you be doing? Buying? No, of course not. Selling. You want to look for selling opportunities in this market condition. And I know some of you might be thinking, Rayner, these examples, they are all, clear as daylight, though. But there are times where, it's not so straightforward, Rayner. I get it, right? So let me just share with you some less straightforward example, right? How about this one here? So if you look at this one, this is the S&P 500, and from the looks of things, you might think that, oh, Rayner, this is a uptrend. You should be buying, right? Look at this, Rayner. Market is heading higher. But then, if you look back a little bit more, then Rayner, there is this strong bearish momentum towards the downside as well. But if you look even further back, there's this uptrend over here. Rayner, help! Should I be buying or selling, Rayner? So this is where a little bit of multiple time frame analysis comes into play. If you are looking at a certain time frame and you can't tell whether you should be buying, selling, just go up one time frame higher and see the big picture, right? Things will be clearer then. So in this case, right, since on this one is the daily time frame, you want to go up a time frame higher, which is the weekly time frame. If you look at the weekly time frame, right, things are different, isn't it? At this point in time, you can say that this market, in the long term, it's in an uptrend, right? You still see a series of higher highs made over time. And you don't necessarily have a higher low because at this point, right, the price has pretty much taken out this previous area of support, this swing low. But you can agree, right, that at this point, the price is still heading higher, about to retest this highs over here, possibly. So at this point, right, you can conclude that this market, this trend, the overall trend is still towards the upside. And you want to look for buying opportunities, right? Just one more example, right, to nail home the concept. How about this? Aussie dollar. If you look at this chart, again, similar, right? Rayner, should I be buying or selling? Because if you look at this, Rayner, this is where the price is heading higher. But Rayner, over here, the price is heading lower. So should I be buying or selling? Again, don't complicate matters, right? If you are not sure, just go up one time frame higher. So from the daily, you move up to the weekly. So now, my friend, do you see how much clearer things have become? At this point, clearly you want to look for selling opportunities, right? Because on the weekly time frame, the price is making a series of lower highs and lower lows. Okay? So I hope this gives you an idea, right, to know whether you should be buying or selling at any one point in time. And one golden tip that I have for you is this. If you are in doubt, stay out. There are so many markets out there. Don't force yourself to trade a certain market if it's not clear. So there will be times, right, trust me, even though you have applied the concept I've shared with you, right, looking up a higher time frame, you will still be confused. I don't know whether you should be buying or selling. And hey, stay out of the market. No one is pointing a gun at your head and telling you to place a buy order. Okay, so with that said, let's move on. Now that you understand, right, the first thing to look out for is market structure. What's the second thing? Number 2, area of value. So once you have identified the market structure, the next thing to look out for is where is the area of value? Where might potential buying or selling pressure come in? Because just because the market is in an uptrend, it doesn't mean that you want to be buying immediately, because the market might be ready for a reversal. It might be about to make a pullback. So you want to trade from an area of value. An area of value can be defined numerous ways. It can be support, resistance, trend line, moving average, channels, etc. So there are many ways to define an area of value, and I'm just going to walk you through, right, a few ways, right, to define it. So moving on, you see over here, dollar against the Turkish lira. If you look at the weekly time frame, right, you would see that at this point, the area of value might not be very obvious. But when you pull out, let's say, a moving average, in this case, the 50-period moving average, you find that this market tends to find value at the 50-week moving average, right? Tested once over here, twice, thrice, almost four times, 5 times. So if you ask me, right, there's a good chance that it might find value again at this $6 price point, which is a confluence of this area of resistance, and this is the 50-week moving average. So this is an area of value to look out for on the dollar against the Turkish lira. Okay, next one. How about this one? Aussie against the Swiss franc. In this case, you have multiple areas of value, right? You have the 50-week moving average again, right? See this one, tested once, twice, thrice, almost 4 times. Then you have your classical support resistance, right? You can draw this one over here, this line, right, where the price previous support, which could act as resistance. Okay, and same for this one, this area of resistance. And there's another one over here as well. So in this case, right, you have multiple areas of value on this chart. And it might even be possible to draw a downward trend line as well. And let's see, one more example. How about the S&P? Okay, so in this case, the area of value, I would say possibly this over here. You can see that this is an area of support, tested once, twice, and this third time over here, very strong price rejection. And that's not all. If you look back in time, right, you are able to draw actually an upward trend line going back 2009 financial crisis, something like this. So you can see you have multiple areas of value on this chart. Number 1 could be this area of support over here. Number 2 could be this upward trend line, which I can just do another parallel one to define the area. There you have it, right? Multiple areas of value on this chart. Make sense? Okay, so this is how you define an area of value. So this means when you are looking for buying opportunities, this is a potential area to look for buying opportunities. This is another one. Okay, so once you have identified your area of value, it doesn't mean you buy the moment the price comes into an area of value, because you want to look for confirmation, right, that, hey, buyers are stepping in, right, and, ready to take the price higher. So this is where you move on to the third thing to look out for, the entry trigger. This is what will get you into a trade. This is what will tell you, hey, Rayner, or hey, John Doe, now is the time to buy, right? So you are looking for an entry trigger. An entry trigger, again, numerous form. Could be a simple price rejection like a bullish engulfing pattern, shooting star, hammer, or a break of structure on a lower time frame, or a trend line break, or some people even use indicators, right? Crossing from oversold to overbought, right, as an entry trigger. That's fine as well. So in this case, let me just walk you through a few common entry triggers that you can use, right, in your own trading. So first one over here, Euro New Zealand 8-hour time frame. Let's have a look and see what it offers. So in this case, this is what I call a price rejection or a false break at this point, right? This two candle here. Okay, you can see that this two candle actually took out this lows over here, this swing low over here, right? And then price reverse up higher bullishly back above this area of support, back above this swing low. This is what I call a bullish price rejection, a false break, right? Where the price actually broke down below this swing low and then reversed strongly in the opposite direction. This is one example of an entry trigger. That's not the only one, of course. You can also look for what I call a break of structure. So if you look at the S&P 500, the daily time frame, okay, got a number of lines over here. Let me just remove it. So at this point, you've seen earlier that the S&P 500, it found area of support over here around the 2321 area. And before it reversed, right, what you see, right, the price action is that it made a series of lower highs and lower lows. Over here, there's another low, a minor low over here, and another low over here. Right, so at this point, right, if you look at the at this point, right, you can see that clearly, right, the sellers are in control. They're just pushing the price higher, making a series of lower highs and lower lows. So now, a break of structure means, right, that the price has invalidated, right, this existing market structure. So this market structure right now is making a series of lower highs and lower lows. And to break it, you need to make a series of higher high and higher low. And this is what happened. All right, at this point, you can see that the market made a higher high when it broke out of this swing high with a higher low. So this is what I call a break of structure, and it's another entry technique that you can use, right, to get into a long trade. I mean, you can use it for a short trade as well, and it will just be a lower high and lower low. Okay, so this is what I mean by a break of structure. And finally, you can also use what we call a trend line break. So what you're looking for is, in essence, right, let's say market is in an uptrend, okay, and you are thinking, where should I buy the pullback, right? How do I time my entry on the pullback? Well, you can use a technique called the trend line break. Okay, so again, over here you can see you can draw a trend line right from the highs over here. This is one trend line, then this is possibly another one over here. Okay, and when the price breaks out of the trend line, in this case, let's say it broke out of this trend line over here. Okay, this one over here, this trend line draw lower. In this case, this one, the price broke out of this trend line. You can look for buying opportunities to get long. So again, of course, right, this trend line, on hindsight, it looks easy to trade, right? So one tip that I have for you is this, right, is that sometimes, right, when you do or trade the trend line break, you don't want to be too early, because if you see, right, in this case, if I have another trend line over here, okay, and you trade the trend line break, this might be either a losing trade or break-even trade. So one tip that I have for you is, again, let the price come to an area of value first, then you trade the trend line break. Right, I don't want to go too deep into this because I will talk more about it later. But generally, the idea is, again, let the price come to an area of value first. So in this case, the price is at the area of value. Then you apply the trend line break technique. This one quite almost there. So this one might be a little bit discretion, up to your discretion whether you want to trade it or not. Over here, you can draw another trend line break. Okay, at this point where the price came into this area of value, then you apply the trend line break technique. So this means, right, before you apply the trend line break technique, you want to make sure that the market is at an area of value, right, before you use this entry trigger, right? So that's just one tip for you. So now that you understand, right, the entry trigger, you know how to look out for it. The fourth thing you want to look out for is the exit if you're wrong. This simply is to ask yourself, right, have I clicked like and subscribe to the channel? Well, if you haven't do it, then do it right now. Okay, so where was I? Yeah, exit if you're wrong. See, I got carried away, right? Exit if you're wrong. This means, right, is where do you put your stop loss on your trade? Right? At what level will the market prove you wrong? At what level will your trading setup get invalidated? So let me just give you a very simple explanation. Okay, head and shoulders pattern, right? You know what it is, right? It looks like just three triangles like that. So let's say the market breaks down below this neckline and you go short. So let me ask you, at which point on this chart will this head and shoulders pattern look distorted? Will it look funny? Will it look wrong? Well, the answer is above the highs, right? If you imagine the price breaks down and it goes back all the way up high to these highs, does this still look like a head and shoulders pattern to you? Not quite, right? It looks like some, I don't know, some mountains or whatever. So clearly, this is where I'm coming from, right? You want to place your stop loss at a level where it invalidates your trading setup. Okay, so let me walk you through a few examples, right? Because this is something that you will be using on every trade. So the first one over here is, let's look at, how about Pound Aussie? Okay, so if you look at Pound Aussie, the weekly time frame, you can see that, okay, where is the area of value? So area of value, I would say it's possibly here. Okay, here, here. And let me just draw one more line. So let's say the market now is at this area of value and you are long. Maybe there's a bullish reversal pattern like a hammer like this, and you go long. So let me ask you right now, at this point in time, right, at which price point on the chart would this setup be invalidated? Would this area of value be broken? At which point on the chart, right, would the previous resistance that should act as support, right, be destroyed? And I'm sure you can agree with me that if the price were to reach around this, let's say, 180 level, okay, or maybe just about here, then clearly this area of value, this area of support, right, is invalidated. It's no longer intact because the price has just breached through it. It has broken below it. Make sense? Another example. Let's say, how about the Aussie against the dollar, the 8-hour time frame. So at this point, you can see that you have a series of higher highs and higher lows. So let's say, you bought the breakout of this highs. Okay. Now let me ask you, at which price point on the chart, right, would you know that your breakout has failed? Okay, so if you ask me, there are two possible levels. Number one, you can reference from these lows over here, and at this point, right, if the price reaches this level, then clearly when the price breaks out and comes back down, this breakout has failed, right, because it breaks out and then reverses down lower. I know this is a very familiar picture, right, because many of you buy breakouts, get caught, stopped out, and the market reverse higher again, right? So not trying to traumatize you, but that is a logical place to put your stop loss, right, at a point where your breakout trade has been invalidated. Another way you can put it for more aggressive traders is that if the price, let's say it breaks out, okay, let's say over here this is the breakout level, it breaks out, right, and if it comes back to the middle of the range here, then clearly the breakout has failed as well. It doesn't mean that the trend is invalidated, but it means that the breakout trading setup that you have traded, right, is invalidated, right, because the breakout trade doesn't look like how a breakout should be like, right, because if you imagine this, the price breaks out of this highs and it comes back down lower to the middle of the range. It doesn't quite seem how a real legitimate breakout should be like. So here are two possible levels to consider, right, depending on how aggressive or conservative you want to be. So this is what I mean by placing your stops, right, at a level where it invalidates your trading setup. And just one final example, right, looking at this one over here. If you look at this again, this is the 5-year bond futures. Again, you can see the potential ascending triangle that's being formed, right, and a higher lows into this highs. So let's say the market breaks out of this ascending triangle. At which price point would this chart pattern be invalidated? Is it over here? Is it over here? Or is it over here? So let's call this A. Let's call this B. And let's call this C. What's your answer? 5 seconds. 1, 2, 3, 4, 5. The answer is C, right? That at point C, if the price reaches point C, clearly this ascending triangle pattern is invalidated. The price can go back to A or B, but you can see that the ascending triangle is still intact because the trend line is not broken yet. This is the trend line that I'm referring to. Okay, so this is a very simple concept, right? But it's useful, right, to placing sound logical stop loss. Okay, and that's the fourth part, right? Knowing when to exit when you're wrong. And finally, where to exit if you are right. What if the market moves in your favor? Where do you exit the trade? So for this part, right, you need to look out for two things. Number one, ask yourself, are you trying to capture a swing or are you trying to ride a trend? So using with different goals in mind, you would use different trading techniques. So if you're trying to capture a swing, right, then what you have to do is have a fixed target profit, usually at swing high, swing low, support, resistance. Some people even use Fibonacci extensions. It's up to you. For trailing stop loss, you can use techniques like moving average, price structure, chandelier crow stop. There are many out there, but again, I'm just going to go through with you the few popular ones, right? And if you want to explore further, right, you can look through at the other training materials out there. So first and foremost, let's talk about fixed target, right? This is very simple. Let's say this is New Zealand yen, okay? Let's say 8-hour time frame. Let's say you have a entry trigger to go short, right? Maybe there's this price rejection over here, a bearish engulfing pattern, you went short. And you want to capture a swing in this market. So ask yourself, right, looking at this chart right now, where might potential buying pressure come in? Because you're selling at this point in time. So you want to exit your trade before the buyers step in and push the price higher. So if you look at this chart, ask yourself, where might potential buying pressure step in? And from the looks of things, right, I would say they could possibly come in around this area of support, somewhere here. Okay, so if I want to take profit, if I want to capture a swing, I would say the $64 price point, right, would be a level I'll be looking at to take profits. Make sense? Okay, great. Moving on, what about palladium? Okay, palladium, daily time frame. So if you look at this one over here, right, let's say you happen to buy the breakout of this high. So right, let's say hypothetically, market is an uptrend, so let's buy. Okay, so you bought the breakout and you want to capture a trend. So what can you do? Well, one way to go about is using the moving average, right? So what you can do is, depending on the type of trend you want to capture, you can use the 20 MA for capturing short-term trend, 50 MA for capturing medium-term trend, and 200 MA for the longer-term trend. So in this case, let's say you want to capture a medium-term trend, you can just overlay the 50 MA and then trail your stop loss, right, using the 50 period moving average. So when the price closes below it, right, then you exit the trade. So in this case, you would, ride the move up higher, swallow this drawdown, this retracement, but because it's not closed below the 50 MA yet, you'll still hold on to the trade. Then it goes up higher, 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 down, retracing, ouch, ouch, pain, 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 retracing, ouch, 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 ouch. All right, then you exit the trade, right, when the price breaks and close below the 50 MA, right? So this is how you trail your stop loss using moving average. And one final technique again I can share with you is using simple price structure. So you know that in an uptrend, the market consists of a series of higher highs and higher lows. So at this point, right, let's say, again, hypothetically, you bought the break of these highs. Then you want to trail using price structure, right? You can see that the price heads up higher, retrace, heads up higher, and then it returns down lower and breaks below this swing low. So at this point, okay, at this point, this specific price point, the price has broke below this previous swing low and you exit the trade. Okay, so you can see that it's not foolproof, right? There are times you might exit the trade prematurely, but the key idea here is just to simply trail your stop loss using the previous swing low, and to ride the wave up higher. Okay, so another option to consider. So with that said, right, again, all right, we have covered quite a bit, right? So let me share with you a few examples on how to piece the puzzles together, right, on the 5 things to look out for. So if you still remember, right, what I've shared, number 1, we talk about the market structure. First thing to look for is market structure. Number 2 is the area of value, right? Where is the area of value? Number 3, the entry trigger. What is the thing that will get you into the trade? What is the signal? Number 4 is the exit when you are right and exit when you are wrong. Basically, where is your stop loss and where is your targets if you are trying to capture a swing. So yeah, so for this part, it's actually 2, right? This exit if you're right or wrong. So there could be another E over here, right? This could be exit if you're right. This is exit if you're wrong. So as you can see, this is what we call the May formula, right? So some of you might be familiar with it, some of you not. Doesn't matter. So let's walk through a few examples, right? And see how we can apply this May formula to your own trading, right? It doesn't matter whether you're trading stocks, forex, the daily time frame or the weekly time frame. This concept can be applied the same. First example, let's have a look at the euro against the Swiss franc. How about that, right? So at this point, right, what is the market structure of this chart that you're looking? Downtrend? Yes? Great, right? So we know that the market structure here is in a downtrend. Next thing, area of value. Where is the area of value? So from what I'm seeing over here, right, we have a possible area of value at this area over here, right, where this is an area of resistance. So area of value is resistance. Number 3, entry trigger. Do we have an entry trigger to trade this market? From the looks of things, I see a price rejection over here and then another price rejection over here. So multiple price rejection. I'll say that is a entry trigger to short this market. So let's call it a PJ, right? Price rejection. Oh, sorry, PR. Okay. What about exit if we are wrong? Right? This is the other E. Where will you exit if you are wrong? I would say at this point, right, where the resistance will be invalidated if the price, reaches this level over here. If you can reach this level, I would say, hey, this resistance, it's broken and I should be out of the trade. So yes, we have our exit if we are wrong. We call this the stop loss. Okay, and finally, exit if we are right. So again, this depends on what you're trying to achieve. Are you trying to ride this downtrend or you're just satisfied with capturing one swing? If you're just happy with one swing, then this is a possible target, right, to exit your trade at this area of support. Okay, so let's call it swing. We have this area, right, to capture this one swing. So this is how you apply the May formula to your trading, right? Let's look at another example. Canadian yen. Again, what is the market structure? I would say market structure is down, right? Market is in a downtrend. Area of value, where is it? I would say this is an area of value at resistance. So we call it R. Entry trigger, right? So this is M, this is A. Entry trigger, do we have an entry trigger? At this point, not quite, right? Because the price is still a little bit off from the area of value. So this one, not yet. So once we... How about exit if we are wrong, right? We know that if we have an entry trigger to go short, right, we want to be out of the trade, right, if the price, reaches around this $79 price point. Because if you can reach the $79 price point, then clearly this area of resistance is broken, right, and we want to get out of the trade. Okay, so this is exit if we are wrong. What about exit if we are right? How are we going to handle this? So maybe this time around you want to ride a trend. That's cool, right? So what we can do is you can use price structure to ride the trend. Maybe the price comes up, get rejected, we go short, and we continue holding the trade, right? As long as the price makes a series of lower highs and lower lows. Okay, so this is how you apply the May formula. One final example, right? Sounds good. Copper, right? So let's look at one final example. So when you look at this chart, again, you're confused. Man, Rayner, I do not know whether I should be selling or should I be buying. Oh, Rayner said look up one time frame higher. So let's do that right now. So you look at the weekly time frame, you see that, hey, copper is actually in a long-term downtrend, right? This is simply a retracement, right, against this long-term downtrend. That's great. So looking at the daily time frame, okay, we could look for possible trading opportunity. But you know what? Let's go down even one time frame lower and look for a break of structure. Sounds good. So at this point in time, right, you can see that clearly the buyers are still in control. If you just pull out your trend line, okay, you can see that the price is still above this trend line. So what you're looking for is a break of structure. So the existing structure right now in this market is a series of higher highs and higher lows, uptrend. So you want to see the price break below this price structure, right? If you can come down lower, retest and break down, at this point, you have a lower high and lower low. And your trend line, right, your upward trend line is broken as well. So now you have a break of structure and this broken trend line. So that could be an entry trigger to go short, right, when the price forms a lower high and a lower low over here. So now you know that the market structure, in this case, this one is a little bit more advanced because you're using multiple time frame analysis, but you're seeing that yes, overall the trend is still down. Your area of value is at this area of resistance over here, which I think you can't see it, but if you look at the higher time frame, it's at this resistance. Your entry trigger is a break of structure. What about stop loss? What about stop loss, right? So this one is a bit special. So in this case, right, you can reference your stop loss at two possible options. Number one is at this swing high over here, or number two, this one over here, depending on how aggressive or conservative you want to be. So let's say you're more aggressive, you're willing to go with tighter stop loss, you can reference this highs over here. So your stop loss can just be somewhere over here. Because if you think about this, if the price breaks down and then reverse back up higher, then clearly, right, this trend line is not broken, right? It's just pretty much a false break and you're wrong and you should get out of the trade. Okay, so this is a E exit if you are wrong. What about exit if you are right? Okay, so let's say if you want to capture a swing, you know that this is a possible area, right, where potential buying pressure could come in at this swing low over here. You can look for targets, right, at this area of value, at this swing low over here, and that could be exit if you are right. Does it make sense? Okay, so these are the 5 things to look out for before you place a trade. I hope you got a deeper understanding of how this works. And to do a quick recap, number 1, look at the market structure. Number 2, look at the area of value. Look for the area of value. Number 3, look for a valid entry trigger to get into the trade. Number 4, look to know where to get out if you're wrong, right? The exit if you're wrong. And number 5, you must know where to exit if you are right as well. Okay, so with that said, I hope you got value out of this training. If you want to learn more, then what you can do is just go down to my website over here, tradingwithrayner.com. This link over here, and just download this guide, the ultimate guide to price action trading, to learn more about price action in the markets. Or if you want to learn more about candlestick patterns, then this guide is really useful. Okay, and it's really would complement, right, what you've just learned today. So with that said, I have come to the end of this training. If you've enjoyed it, smash the thumbs up button, subscribe to the channel, and I will talk to you soon.